Okay, I literally just realized I forgot to show you how to finish calculating option prices, and I don't know what happened. I guess I'm retarded. I tell you this all the time. But anyways, I'm going to take just a few minutes and show you this real quick. So anyways, you type in the stock you want on this website. I'll link it below. It's the options calculator from the OCC, which is the Options Clearing Corporation. The two options choices are American, European, depending on where you are. The only difference is that you cannot exercise European except for the day of expiration. So in this case, it would be only tomorrow you can exercise for European. So for American, you just keep it there for the price you want. I went ahead and determined that that's the closing price after hours, and this is how you would tell how much your profit could be or how much your call may be worth in the morning. Like say your stock ran up 5% after hours. Well, since you can't trade after hours for options, you can put in the price, calculate it this way. This was developed by somebody at Salomon. They won a Nobel Prize for it. So what you do is you put in the strike you want, make sure the IV is correct, and we can see that the call's worth 0.09. And you go look, and based on the data here, you're paying a premium for these contracts as they're priced in at 0.11 and 0.12 ask, meaning, you know, 0.09 to 0.11. While it doesn't look like a lot, you know, on paper, percentage-wise, that's quite a bit. So just keep that in mind. And being expiration, there's data is not on your team here. So if you look at the puts, 2.18, you go back and look. Right here, it is 1.99. So puts are actually at a slight discount, but again, data is not your friend here. These are in the money though. That's the difference. These have intrinsic value built in. That's why they're not as invaluable as the calls. So that's how you do it.